Hello guys, welcome back to the channel, the Daily Forex. In this video, I'm going to share with you guys a strategy that you can use to grow your smaller accounts on Boom 1000 index. Okay, you can use this strategy to catch spikes, and you can also use it to scalp the market. Okay, so I'm going to call it a spike cashing strategy to grow your smaller accounts, and also a scalping strategy. Right now, what we're going to do right here, we're currently seeing just two indicators on our chart right now, and on my chart right here you can see that there's the Forex index and there's the stochastic oscillator, and we have three levels right here for the stochastic oscillator. All right, now what we're going to do right now is to show the parameters. Right now, on the parameters on indicator window 1, you want to put the Forex index right here first. For the Forex index, the period is going to be on the level of 4. All right, you want to put 4 on the period. Then method is going to be simple. All right, then for the volume, you're going to put it to tick. For the time frame, is going to be on all time frame. Then you put a style on 1 pixels. You can use the color blue. All right, you click on done for the Forex index. Okay, then the second indicator is going to be the stochastic oscillator. All right, you put a period on 5, D period on 3, slowing on 3 as well. The price feed is going to be slow/I. The method is going to be simple. All right, for the levels, you want to put 20, 80 and 8. Okay, 20 is the first, 80 then followed by 8. All right, the style, you put the pixels on 4, the color black, then you use this middle line right there, then you click on done. All right, the main, you put the color on white, 3 pixels. The first line right here, just as you can see, the signal 3 pixel, then this color red. Okay, you click on done. All right, this strategy is not that hard and not difficult. Okay, you can easily understand and use it to grow your smaller accounts. You can either avoid spike, or you can catch the spike, or also scalp the market, taking advantages of small price movement from the market. Right, all right, now take a look at this point right here. This is the Forex index line. Okay, now whenever the spike wants to come into the market, this Forex index will spike up, okay, above the level of 20. Now this right here is a level of 20, this line right here is 80. Okay, this one 20, and this last one is 8. So whenever there's a spike coming into the market, this Forex index will spike above the level of 20. All right, it spike above the level of 20 all the time. Okay, so when it spikes, this red line will follow. Although this line, even though it spikes upward, it may go down below. Okay, but before the market spikes, the Forex index will go above the level of 20. Then when it gets downwards, this red line right here, which is the stochastic oscillator, will also spike, giving you a buy on Boom market. All right, now this right here, you can see at this point there was a spike on the market, meaning that the Forex index spiked upwards, followed by the stochastic oscillator. Now you can see that after this point right here, there was a candle tick for a sell before the spike came through, and when the spike came through, it was this red line, the stochastic oscillator. All right, as you can see, now at this point you place a sell. This is when you scalp the market. Place a sell at this point right here, when there's a crossing between the Forex index and the stochastic oscillator. All right, the Forex index will go downwards, the stochastic oscillator will cross downwards as well. So both indicators crosses below and giving you an entry for a sell. Then this is the safe zone in between this blue line and this red line right here. So at this point right here, you place a sell, you count 1, 2, 3 candlesticks right here. From here, 1, 2, 3. Okay, then you exit when there's a crossing below this red line and this blue line. I hope you understand, because outside this box, outside this space right here, the market would spike. Okay, the market would spike, although it won't give you, a signal immediately for that spike. Remember, like I said in the beginning of this video, that the Forex index will spike up immediately above, giving you a signal that the market is going to sell, giving you a signal that the market is going to buy. Okay, so as you can see right here, this red line is below the level of 8, as you can see, and the market, if we zoom out, we can see that the market is at the oversold. So the market is at the oversold, meaning that the next step is that the market will buy. And if you put on the moving averages, you will see that the moving averages is about to curve upwards. Okay, the moving averages is about to curve upwards, giving you a signal that the market is going to buy. And because this market is at the oversold, the next step is a buy. So that is how it always works. Okay, when market gets to the overbought, the market sells. When market gets to the oversold, the market will buy. It's price. When price gets to the oversold, the price will go upwards, spike. When price gets to the overbought, it will fall downwards. Okay, now that's how it works. And you can see when it spike upwards, giving you a signal that the market right here is about to buy, like I said. Okay, now if you want to take advantage of small price movement, like taking like 5 candlesticks, 10 candlesticks from the market, all you need to do is just place a sell when you see a crossing at this point. Okay, when you see a crossing at this point right here, while using the 1 minute time frame, when you see a crossing downwards here, you place a sell immediately. Then once there's a crossing again between the red and the blue line, which is the Forex index and the stochastic oscillator, crossing below this level of 8, you exit the market, because the market would spike. The spike won't come immediately, but you'll be expecting the spikes because the price is outside the safe zone. Okay, so I call this point the safe zone. Let me mark it for you guys so that you can see this point right here. I call it the safe zone. Okay, this point, this middle right here, let's zoom in a little bit so that you can see what I'm talking about. Now this space here, you can see this arrow is inside the safe zone. Okay, so at this point right here, let me mark it for you guys so that you can see what I'm talking about. At this point right here, this crossing right here, this crossing right here, between this crossing right here, you place a sell. Then once the market is outside, once you see that there's a crossing, this is the safe zone inside. Once there's a crossing below, you see below this level of 8, you exit the market, because the spike would come into the market. Now most people will ask about the zoom level. If I'm using the 4th zoom or the 5th zoom level, the zoom level don't really matters in this strategy. Okay, it don't really matters. All you need is to set the parameters right, the settings, the styles, the color you want to use, and the period you want to use, so that you'll be able to see the indicators clearly on the market chart. Okay, now you can see what I've just shared with you guys. Now if you take a look at this point, okay, this works. Okay, you can see this is fact, it actually works, right? At this point here, there's a spike. Take a look at this point right here, there's a spike, and if you trace it downwards to the indicator section, you will see that when the Forex index spike upwards, immediately there was a spike. Okay, when it went upwards, the market bought, and you can see at this point right here, you place a sell. Okay, you place a sell. If you count from this point to this point right here, that's a good amount of profit, almost about 6 candlesticks. Now imagine that you are using a lot size of 2 or 4, the amount of profit you are going to make. So, and remember that the amount of lot size will equal to the amount of profit you will make. Okay, the amount of profit and loss you will make on the market. Okay, so now why this strategy is good, there's always a downside to every strategy. Okay, now you just imagine that at this point right here, you sell and you exit this market at this point to be safe. Okay, like I said, this right here is the safe zone. Okay, now when you want to catch the spikes, that's when the market is a little bit tricky, because the first index keeps on going upwards. Okay, it will spike upwards, trying to tell you that the market would buy. Okay, then it will go downwards immediately, and when this red line will come up, it won't give you any sign. Okay, so to be safe for the market, exit during this point and be expecting a buy outside this box when the first index is spiking upwards. Okay, so you can see even at this point right here, you can see that there's no spike inside this safe zone. Inside this safe zone here, inside this space, there's no spike. There's no spike. If you check the historical trends, there's no spike inside the safe zone, and it works. Okay, so before you carry on this strategy, make sure you practice this strategy on your demo account before trying it out. Okay, make sure you study this strategy by yourself. Don't just take this strategy and use it. No, don't do that. Okay, you want to practice facts, plan your strategy, analyze the market using the same strategy before you implement it on your account. Okay, this strategy can really help you a lot in your trading. Okay, at this point here, there was a spike. You take a sell for 5 candlesticks. Even though it's not 5 candlesticks, all you need to do is wait outside the box. Wait until you get to this point right here. When there's a crossing, then you exit. At this point right here, you place a sell. When they cross, you exit right there. At that point, you can see, very perfect. There is no spike inside the box. There's no spike inside the safe zone. Okay, inside the safe zone, there's a crossing. You take a sell at this point, you exit outside right here. Okay, perfect strategy for you to make profits and for you to grow your smaller accounts. Okay, when there is a crossing at this point right here, when there's a crossing, you place, not at this point. Okay, not right here. When there is a crossing, take a look at this. When there is a crossing above, right, when there is a crossing, you place a sell for 5 candlesticks. Okay, so I hope you understand what I've said. Remember that the crossing needs to be downwards when the market is going downwards, not when it's going upwards. Okay, when it's going downwards, like here at this point, you see that there's a curving going downwards, so the downwards trend right here, you place a sell when there's a crossing downwards, not when it's going upwards. Okay, not upwards, downwards at the top right there. When the market is curving downwards, that's when you want to place your sell for your 5 candlesticks, or you can wait and exit outside the safe zone. All right,